Hi, I'm Natalie MacDonald bringing you another exclusive interview. The Bank of England inflation report released today claimed that inflation will remain above the 2% target until 2016, 3 years longer than previously forecast. Stephen Lewis of Monument Securities is on the phone with me now. Stephen, while this in itself is simply a confirmation of recent discussion, when you then consider that the BoE had previously expected to meet this target by the third quarter of this year, what did the Bank of England not factor in?
There were two main factors which have led to the increase in the Bank of England's inflation projection. One of these is that the rise in regulated prices has been a lot stronger in its impact on the index than Bank of England economists thought would be the case last November, especially university tuition fees, which had a very pronounced impact. But also the Bank of England has to include this time the effects of the fall in the sterling exchange rate, which has occurred in recent weeks. The exchange rate will have an effect on import prices and through them the level of consumer prices here in the UK. So that too is an element in the rise in the forecast.
Where then ideally would you like to see UK inflation sitting?
It would be nice to see inflation occasionally around the 2% target level. That would tend to bolster the confidence that households and companies have in this target. The problem with inflation continually running well above 2% is that expectations could become dislodged from their anchor, and that would then tend to reinforce the upward pressures on inflation through higher pay claims and through the pricing policies of companies.
In your opinion, Stephen, could incoming Bank Chief Mark Carney's favoured framework of flexible inflation targeting assist with this? Or is it simply a strategy that would allow Mr. Carney to hit self-set targets once he takes over the BoE in July?
Well, it's hard to see how much more flexible the Bank of England's inflation targeting could be. But I was quite sympathetic to Mark Carney's view that if the bank is going to target growth as well as inflation, then it might as well adopt a target to nominal GDP. That would at least make clear to everyone in the economy what it is that the Bank of England was really trying to do. And if then there was a wide miss on inflation, and this was in conditions where the economy was shrinking, it wouldn't be regarded as a policy failure if the Bank of England then decided to respond to that by easing its policy levers. As it is at the moment, it does look as though the bank has suspended its stated target because of extraneous circumstances. And that's a much more difficult approach to sell to households and companies in the economy as a sustainable policy framework. So I think Mr. Carney probably will come back to this once he gets his feet under the desk at the Bank of England, and he will try to articulate more clearly the relations between the Bank of England's growth aspirations and its stated inflation objective.
The central bank has also commented that they remain open to additional QE, with the report stating that GDP is expected to grow in Q1 of this year. How does this bode for further monetary easing in 2013?
I understood the Bank of England's words in the report today as meaning that they would resort to additional QE or other measures of policy easing if growth turned out to be weaker than they currently expect. So as long as GDP does grow in Q1 and then we get a gradual improvement in conditions, there may not be any more monetary easing undertaken. But if, on the other hand, there is a crystallization of some of the risks, not least those in the Eurozone, then that affects growth rate in the UK, so that it's much slower than the Bank of England currently expects, or even if the economy contracts, then the Bank of England will be willing to have resort to other measures, and they will probably include some more QE. So more QE can't be ruled out for this year, but the bank's best guess is that it won't be necessary.
You've mentioned already that a depreciating pound contributed to yesterday's CPI figure of 2.7%. The pound has continued to fall for a third day against the euro, approaching a 15-month low, following what economists are now describing as a gloomy report. The British currency has already weakened 4.6% this year. How much further do you anticipate the sterling heading?
Well, sterling on the effective rate, and it's the effective rate that the Bank of England always monitors, it's still within the range of fluctuation of the past 18 months. In the middle of 2011, it was down at 78 on the effective rate. It's just below 80 at the moment. So I think that it could go down another 2% or so without anyone in the Bank of England being too concerned about it. In a world where there is, well, if not a currency war, because we're not allowed to talk about that, but a currency free-for-all, then what has happened to sterling does preserve some of Britain's competitive advantage in global markets, and it's a central point in the bank's forecast for GDP that there is a recovery in British exports. It's very important that that should occur. So I don't think that anyone in authority feels that the performance of sterling is a problem. It is something which has rectified what was, towards the end of last year, an extreme position, and one that was quite uncomfortable for UK exporters. I think it could go down another 2%. The pound always does rather poorly in the first quarter of the calendar year. That's where it's seasonally weak. I would expect after Easter that we shall see sterling stabilising at that slightly lower level, and I don't think that the pressures on it will be as great as we go into the latter part of this year.
That's all we've got time for, Stephen, but thanks very much for your comments. We look forward to speaking with you again soon. I'll be back tomorrow with a look at one of the headlines of the day as part of our press review. Until then, though, goodbye.